Hey everybody, welcome back to my channel. As noted in the last video, I will skip the weekly technical analysis videos for the next 3 weeks, and as a replacement, I will begin a 4-part series about the financial market. In each part, I'll be breaking down some of the basics in ways that are easy to understand. Starting off this series is foreign exchange. I'm from the banking industry and a big chunk of my career is spent in this asset class, and I hope that you'll find my sharing useful or interesting. This part will be divided into several videos, first of which I'll explain what foreign exchange is, then I'll run through some of the major currencies, followed by how to read the rather confusing FX crosses and what FX trading is about, before rounding off part 1 with basics on how to analyze FX. Let's start. Foreign exchange is also known as FX or Forex. These names are used interchangeably. To understand FX, you must first understand currency. Currency is a store of value, what you use to buy things or to pay for services. In the US, people use the US dollar, the USD in short. In China, the Chinese yuan is used, or locally known as the renminbi. In the UK, it's the British pound. Now, if you want to buy something, say an apple, you pay a specific amount of currency. In return, you get the apple. The most common understanding from the perspective of the buyer is just simply buying an apple. From the perspective of the seller, selling an apple. But the key to understanding FX is the concept of buy and sell. I can't stress this enough. Every transaction in FX has to be thought of as buying something and selling something. Effectively, you receive something, at the same time, you give something away. Think of this transaction as an exchange or a trade. You are buying an apple and selling your currency. The other person is selling the apple and buying the currency. Now I repeat, to understand FX, you have to think this way. When you buy something, you are also selling something as well. In the simplest form, FX is the exchange of currencies, specifically the exchange of foreign currencies, hence foreign exchange. An FX transaction involves buying one currency and in the same transaction, selling another currency. The buying and selling of currencies is called FX trading. There are two major reasons why people trade in the FX market. First would be there is a need for a specific currency. Second, speculation. Let's talk about the first reason, need. For example, if you're from Germany and want to go for a holiday to the US, you need to buy US dollars in order to make payments because businesses in the US, especially the smaller ones, are unlikely to accept the euro, the official currency of the Eurozone that Germany is part of. So you need foreign currency to make payment in a foreign country. You'll need to buy the US dollar and sell your euro. Another example, an investor from the US wants to buy a house in England. The investor will need sterling pound. To buy sterling pound, the investor sells the dollar in order to get the sterling pound needed to make this investment. So the second reason is international investments. Last example, say a wine producer in France sells wine to US. The wine producer is paid in USD because USD is generally the default currency in international trades. The wine producer has to exchange the dollar into euro because USD is less accepted as the common currency in France. So to do this, the wine producer sells the dollar and buys the euro. So the third reason is international trade. Do understand that these are some of the most common reasons for the need for foreign currencies. There are other reasons that I did not cover. We've covered the first reason of need with a few examples. The second reason why there are FX trades would be something called speculation, which is making a financial transaction with the hope to profit from potential price appreciation or depreciation of something that may not be of need. Now ask yourself this question. If you know the price of apples, now at $1, will increase to $2 next month, what would you do? That's right. Most likely you'll buy lots of apples now when the price is comparatively lower, then sell them next week when the price is higher. so that you may profit from the price difference. This is speculation. You have no use for the extra apples, and there is no certainty that price of the apples will increase, but you take a risk to buy the apples anyway in order to profit from the potential price increase. Applying this concept of speculation in the FX market, most people who speculate, we call them speculators, do not have an actual need for currencies, but want to profit from the appreciation or depreciation of currencies. Some people think the US dollar will appreciate in the future, so they buy US dollars and sell the currencies that they think will depreciate. Others may think that the British pound will depreciate in the future. They sell the British pound and buy some other currencies that will appreciate. These transactions can be done via online platforms, physically or through brokerages, and they form part of the FX market. The FX market is the largest market in the world, involving trillions of dollars in daily transactions. To be accurate, up to $6.6 trillion is traded daily according to a survey done in 2019. Now that's a lot of zeros. And when I say market, do not think of it as a geographic location where transactions happen. It's not a building, it's not a city, not one single place. Now, market in this context means it's a system in which many parties at many different locations performing many transactions with many other parties involving many different currencies. So, who are the participants of the FX market? Central banks are the biggest participants in terms of the sheer size of sales and purchases. Central banks control the liquidity to the financial markets by buying or selling currencies in the markets. Examples will be the Federal Reserve of the US, Bank of England, which is England's central bank, and the People's Bank of China. This is followed by international banks, particularly those that deal heavily in FX because they facilitate transfers of foreign currencies for their rich clients or their clients trade FX. Then we have the institutions. These can be investment firms, hedge funds, sovereign funds, where they pool monies together to invest in different currencies, hence the need for foreign currencies. Next is the corporations. It can be big or small companies, likely non-financial, and have operations in different countries. They participate in the FX market mostly to protect their currency exposures from future fluctuations, known as hedging, and likely less for speculation. Lastly, the retail participants, the likes of you and I, tourists and students traveling abroad, private investors buying assets in other countries who do not have a consistent need to trade FX, or at least not in large sums. We've now come to the end of this video. I hope you can better understand what FX is based on the information that I've shared. Next, I'll talk about the major currencies because this forms the foundation of FX crosses. If you like what I'm doing, please help me out by giving me a like. Please subscribe and hit the notification button for more videos like this.